Regulatory and Crypto Landscape panel. Thank you so much for joining us today. We are live. Appreciate everyone for joining us and tuning in. Take it away, guys.
I'm not hearing.
What was that, John?
I'm not hearing great audio. I don't know if I'm supposed to. Now I heard whoever that was.
Gotcha. No problem. Happy to kick it off here. Obviously, this is going to be very much blockchain and regulatory focus from a panel perspective. I'm getting a little bit of feedback. Maybe if you aren't speaking, if you can mute yourself, that might help deal with that. Awesome. Okay, great. Yeah, I think, David, that might be coming from you, so just be a little bit mindful of that. Well, thanks everyone for joining us today. I'm going to try to just kick this off, and we can start moving this through a number of topics and discussions. One of the first things I think that everyone has a particular interest in, and not just the panelists here, but those listening in, are issues centered around SEC and the FINRA regulatory landscape going through the rest of the year. Obviously, in the crypto space, this is a very heated topic as we continue to wait for further guidelines and regulations from those acronym agencies. Don, I'd love to get some input from your side on how you see the SEC and FINRA landscape moving forward through the rest of the year, and in particular under the current pandemic issues that we're dealing with.
Well, I mean, I think it depends if you're talking about, let's stay with the blockchain and crypto space. The SEC and other agencies are very occupied in the moment of what's going on with the pandemic, and so they're having to worry about a lot of different regulatory issues. Whether it was, for example, just trading floors being disbanded and people going home to work from there and not having the appropriate SEC compliant telephone taping at the beginning, etc. Now that all's come into focus, but there's a lot of work that's been going on to make everything SEC compliant during this pandemic. I do think that we've seen cases still moving forward in the courts. So a number of different cases. We have Kick and we have Telegram, two very important cases that are still moving forward in the courts with the SEC. The Telegram case has gone to the Second Circuit now. So I think that's we're going to see that unfold more in 2020, and we'll have an emphasis on making sure that the world is safe and regulatorily compliant in the ways in which we can bend some of the rules that enable business to transact.
I think one of those rules that's particularly interesting, and maybe someone here on this panel can add additional color, is the inability for people to make markets from home. I think market making generally had to be done from inside certain regulatory buildings and frameworks. And now we're at a position where obviously no one is within those offices to do that. Anyone able to add a little bit more color to that topic?
Well, I think I just said that, and David wants to say something. So David, no.
I mean, there's a range of things that they seem to be able to forge ahead on, the regulators, and there are certain things that people are encumbered by, one of which is market making, because it depends on how your electronic systems and access are set up and whether or not they're portable. People are not necessarily going back into their home office where they have connectivity, if you will, into major systems. And we see that with FINRA right now. For example, I mean, we own an investment bank. It's in 17 states in the District of Columbia right now, and we're completely stopped on getting people relicensed or taking exams because the Prometric centers are all closed down. That's where the testing is typically done. But if you look at things like new membership applications, continuing membership applications, it seems that FINRA is able to do those remotely. So those are moving forward, and so it's kind of a really mixed kind of bag, and the things that lend themselves to sort of remote work or getting done, and the things where you actually have to be in a place and be supervised are generally a problem right now.
Do you see this forced digital pivot being a precursor to a benefit for the crypto space. Maybe John's, that's something you can talk about from the digital security side, as now a lot of those regulatory frameworks that were very strict or stringent previously, and now we're forced to have to be a little bit more agile in order to properly navigate around them as we start to move back, hopefully, to some form of a norm, or what would be the new norm. Are we anticipating that this change or loosening of that regulation will really pay dividends for the crypto or blockchain space?
This is John. Hey guys. I would say that the way I look at it right now, I think for traditional business, I think, as David pointed out, there are certain traditional things that regulators do that they can do remotely. From my experiences with T0 and Overstock.com under the leadership of Patrick Byrne, I found, from as far back as 2014, 15, it's like any other governmental agency. If there's something new happening, they'd rather ignore it, extinguish it, not lend it any credence until they're forced to. So I feel like, in light of the pandemic, there was a lot of excitement around crypto 2 years ago, even a year ago. I was extremely excited that regulators were taking a progressive approach. They were working with companies like T0 to try to have a dialogue and find a good way to get to a digital security that the regulators could bless. And I just think, unfortunately, the pandemic itself just gives the government apparatus an opportunity to not want to focus on any innovation, any approvals that may be, on the borderline of paradigm changing for crypto. So I think the regulatory landscape is troublesome, even for digital securities. If you look at the Overstock's a public company. I was part of the founding team of Medici and T0. I'm still, in the top 5 shareholders, give or take, of T0. And if you look at, when Patrick Byrne was at the helm of Overstock, he was not reluctant to challenge the regulators and say, hey, show me where I'm doing this wrong, and then I'll adapt. And, since Patrick's gone, if you look at the Overstock digital dividend, while it may sound like a great innovation for digital securities, and I'm a big shareholder in T0, I want to see all the forward plans that we thought about and put out there work. At the end of the day, the regulators were able to push them into a funnel where the ultimate sayer of truth is still Computershare, the transfer agent, on their digital dividend. So as much as Overstock continues and T0 continues to try to be a forerunner, the regulatory landscape that I'm seeing with my own 2 eyes in public filings is that they're more inclined at this time and overall to push things into traditional buckets that they're used to seeing, which I think will, stifle the amazing momentum that was around digital securities and crypto a couple of years ago.
Andrew, if I could pick up on that for a second. I mean,
Yeah.
I'm on the board of INX, which is an Israeli company filed an F1 with the Securities and Exchange Commission. And, we went through 2 years worth of comments, and you see, as they want to issue a token to the public. And, to John's point, we had them, sort of, do what almost, I guess, what you would predict is that the way you regulate, securities, derivatives, money, there are 3 kind of regulatory buckets. And so they want those businesses to fit inside of those buckets. And so everything that they are used to historically, like the SEC doesn't want to be accused if we set up an exchange that trades a cryptocurrency, which will be a currency, or trades a derivative, which would be under the purview of the CFTC. the SEC does not want to be accused of basically going outside of their jurisdiction. So they want everything separated out. And when you go through things like, transfer agent requirements, which are baked into the rules, they want that box checked. When you look at custody, they want that box checked. And so, they're being, I think there is kind of a fear of unleashing something to the marketplace that doesn't have the same kind of protections in it that we've generally enjoyed through more well-developed systems as opposed to these emergent systems. And so they're going very slow, trying to make the divorce. The court has to freeze the assets. How do you do that in a crypto world when somebody owns it in a cyber wallet, for example? And so I think all of these things are being examined, and it's to John's point, it's painfully slow, and it's only going to be made more slow as a result of the COVID crisis.
Yeah, and I mean, I think that just circling back to when you mentioned the transfer agent, for example, one of the suggestions that myself and some other people made in respect to the safe harbor that Commissioner Pierce recommended was, if you'd made some changes in Reg A Plus and you streamlined it and you got rid of, for digital securities and digital assets, the transfer agent rule, which in fact you don't really need for digital securities, it would make that a vehicle in which people could raise money on an annual basis. You do have filings, you do have a lot of disclosure, as David was saying, in what they filed as well, which was an S1. I mean, there are ways in which one can do this with a little bit of leeway into some of the current regulatory framework. It's not as if you have to totally redo it, just loosen up a little bit here and there in order to let some of these offerings go forward in a compliant but not completely roadblock way.
Yeah, that's great. Absolutely. Donna, maybe you can also talk about a little of your thoughts on the process of raising capital pre and post COVID, what that difference really looks like, and maybe even a little bit about your background as well for some of the viewers that may not be familiar with you already.
Well, on the raising of capital, it's particularly relevant that I'm on the board of New York Angels. It's one of the longtime East Coast-based angel groups, though we do have people also that are members from other countries. And so definitely we've seen a lower evaluations going on right now. A number of different funds as well as investors are looking to shore up existing investments that they have instead of committing to new ones. Now, that's putting aside companies that may be particularly relevant for COVID type of situations in which long distance, Zoom, et cetera, places, companies similar to that. And so we've seen a retrenching. We made very sure that all the companies that were invested in, that they looked again at their balance sheet, that they looked where they could cut, whether it was people or expenses or in any way to elongate the amount of money that they had in their coffers to stretch it out. Because if you have money on your balance sheet, it's a very valuable thing at this moment now.
Yeah, I think runway is something that everyone is going to be very, very, very focused on. And even if you look at some of the previous recessions or economic downturns, you'll start to see these valuations coming way down. Love to hear what everyone's thoughts are as far as the kind of reshuffling of valuation. Do we feel that valuation is falling more in line with what's appropriate? There's been a very accelerated view on valuations, especially within the past 36 months. So is this a rebalancing of what would be considered more of an appropriate valuation, or do we see this more as a capital constriction?
Yeah, I mean, this is John. From my perspective, long before I was involved with cryptocurrency, I worked as a subject matter expert for Patrick Byrne at Overstock, and he had these, well-documented wars with the major prime brokers about, inefficiencies in the short selling market. And my background was in short selling, so I always tended to look for things that were overvalued myself, and the continuous net settlement behind most short selling transactions is how I actually got involved in stock loan, and me and Patrick had a shared passion there. But with that in mind, the short selling background, I look at, I would say 90% of the companies that are talking to me right now, their valuations are probably 90% off. And if there were a way to short some of these opportunities, I'd rather be short than long most of them. And the regulatory uncertainty that we were talking about before, everyone has great ideas and we can change this and that. But it's been demonstrated already that the regulators are not motivated to move for innovation. Now, this gives them another excuse. So, I think runways are short. And like you said, I think Donna said, cash is king. Companies that don't have money, I think there's an existential threat, involved in how people are going to deploy capital after this. And unfortunately, one of the uncertain factors in there is the regulatory landscape. So, I think the strongest will survive, and I think the strongest cryptos will survive too.
Yeah, if we look back to 2008, 2009 market crash, some of the powerhouse companies currently in existence, that's when they were founded. If you look back, I think we had Airbnb, Cloudflare, GitHub, Uber, Pinterest. Those were all founded during that 2008, 2009 crash. And in fact, a lot of them actually had to resituate their overall valuation as they went to market for fundraising. So is there an opportunity here, not just for investors, but also for some of these startups to try to make a better value to attract some of the better investors, during this time? I think that's a question that we get at Republic pretty regularly. Should we be fundraising now? Is now a good time? And we always try to look back at some of those previous examples of some of those very, very successful companies that said, okay, listen, we're going to resituate our valuation here. We're going to try to make this very attractive for long-term partners and see if that can carry us forward, long-term. Is that something that anyone else here is seeing in the space? Any type of direction that you've been giving individuals that may be asking similar questions?
I think it's tough to get meetings right now, Andrew. I mean, that's part of the problem. I mean, people are it depends where you are in the market. I mean, if you're looking at earlier stage kinds of companies, I mean, people are generally in a risk-off frame of mind, and they're not taking on new positions, and they're going through their portfolios and looking at doing triage on their portfolios and figuring out how to, if they've got capital powder free, how to ensure that the things that they want to keep that they think are going to do incredibly well, come out the other end of this sort of dislocation we're experiencing with COVID, pretty well. The public markets are really kind of a tale of, two cities. You've got things that have been absolutely crushed in the form of the transportation sector and airlines. Every airline in the country, in the world right now, is looking at some form of a restructuring. And then you look at what happened to energy prices. But, and the technology sector has done, pretty well, and certainly things that allow you to connect over the internet, or like Zoom, for instance, have done incredibly well. So it's a very kind of bifurcated market, but the government's pumping liquidity into stock markets, in the markets overall, and that tends to inflate prices, with the exception of the things that are really fundamentally having a difficult problem with their core business models, like, as I said, transportation and energy right now.
I would underscore the distinction between this and the 2008 crash recession that went on for some years. I mean, here you have a combination of financial fear and health fear, and the health fear is paramount, and it has literally frozen people, not only in terms of money that they're spending, but places and where they're located. We're all in our homes or in some safe place, in order to stay out of the virus's way. And so I think that's a very different mindset, because first and foremost, you're worried about being healthy. And secondarily, you're worrying about the portfolios you have, and it adds more stress to everybody that there is the financial aspect in addition, and things that we're used to doing, we're just not permitted to go and do, so that we can put health at the top of the list of attention.
Yeah, absolutely. And with that in mind, maybe we can move into the kind of the next topic, really around small business lending and how the economy is going to, absolve that, and what that's going to look like long term as we continue to push these stimulus packages forward. So, any thoughts that you guys may have on what that small business lending looks like as it continues to spin up and we continue to add additional funding in order to prop up some of these small businesses?
I was at Treasury in the wake of the credit crisis, the financial crisis, and they had they were trying to work on the recovery, and they were focused on small business lending in particular. I think that what happened in the wake of the financial crisis is we gutted a lot of the small business lending infrastructure that we had in banks. I mean, they just pulled back wholesale, and we had some subsequent innovation that went on with some of the innovative direct lenders that, or if you will, the non-bank lenders that were going after trying to fill in the breach. So in some respects, I think we probably have a little bit better infrastructure now than we had then. But make no mistake, if you don't have cash flow and you don't have assets, you're not very attractive to lend to. And what happens when you have 20 plus million people thrown onto the unemployment line and businesses that are largely getting shut down, and particularly Main Street businesses, like all the restaurants and so on and so forth, is that there may not be much to lend to, and to feel comfortable with the credit. So I suspect that it's going to be a very long road to hoe for certain kinds of businesses to recover from this, great economic pause and sheltering in place that we're going through. And I think that's one of the reasons why you see so many governors now saying potentially imprudent, hey, we need to get back to work. And the one thing you haven't seen in the economic analysis so far is, hearing from the economists, and when people are thrown on the unemployment line and there's an increase in poverty, what are the health effects of that versus the health effects of COVID? And there has to be an optimization plan, and it's going to be a very different plan for South Dakota than it will be for New York, because obviously South Dakota, almost by nature of its geography and its sparsity of population, already shelters in space and probably doesn't run the risk that a concentration of people in New York City does. So, we have a lot more work to do. I mean, obviously testing is absolutely critical, but we don't have the tests out. We're going to have to go through a culling of the population and maybe a bit of an epiphany to understand that, that there are elderly folks that probably, need to be quarantined because they're most at risk, people with the pre-existing conditions, understanding what the risks of the rest of the population is. But we're at some point all going to need to prudently get back to work, because the cure to this, it may end up being much worse than the actual disease itself when you look at it holistically.
I will point out that there have been a couple of very great entrepreneurial projects that brought together both scientists and entrepreneurs. One that I believe started out of Boston, where they addressed over a month's period the lack of the swabs that are necessary for the testing, and it's a very intricate operation to make the swabs. So between a network of researchers and entrepreneurs throughout the country, they put together, and they're now making, I believe, 1 million swabs a week, up from a couple of 100,000 a few weeks ago. And also just in New York, I think one of the companies out of New Lab, and in concert with a manufacturer in Queens, they started making parts for ventilators. And so I think you've seen some entrepreneurial spirit come together, and people working together in ways that they might not have before, crossing the lines between research and business, and sharing in unique ways. That's a positive.
I mean, there's a tsunami of that kind of innovation going on. I'm the board of directors of a company called BioSig, and the former chief medical officer of Celgene took an antiviral that he knew, and we've taken it on, and we think it could be more important than remdesivir because it's oral. This guy's got an amazing track record. He was the chief medical officer of Celgene, which was just sold to Bristol Myers Squibb for $74 billion. I'm in touch with, there's a friend of mine who's a rabbi out in Brooklyn, and he's talking about trying to bring in manufacturing for PPE down to Louisiana. I mean, guys are trying to fill in the breach. We know what the problems are. It's just going to take a while. When you're dealing with drugs, and antivirals, probably the first line of things that'll come into the market. But even with the FDA being incredibly supportive, still have to where with the BioSig drug here pretty quickly through Mayo Clinic. But it's and everybody's pushing, but there's just so much that you can get done, and through a narrow, the narrow head of a funnel, scaling tests, whether they're to look at virus, to detect the virus, or to detect antibodies in a serological form. We're going to need both of those tests to be able to put people back to work in close quarters, and to know that there's not somebody out there that's infecting everybody. But to do it on the scale that we need to see happen is really astronomically larger than it is currently, and it's going to take a hell of a lot of work. It's going to take time. So everybody is working and innovating, and you've got brilliant people throwing their best at it, but it's just going to take some time. And meanwhile, we have a very difficult sort of economic period that we're going to have to bridge, and it's probably going to be 6 to 18 months before we are really kind of back to normal. At least that's my more or less normal in terms of operating in an environment, and then it's going to take a while for the economy itself to heal from what we've now done to ourselves over the last couple of months.
I think one thing to consider too is we're looking at with this stimulus package and the small business loaning feature, really just adding runway to blockchain startups, right? A lot of blockchain startups that you're now instantly giving them an additional 2 or 3 months of runway, depending on how they set it up. And those extra legs can really produce some interesting tech. Are any of the blockchain projects that you guys are working with seeing benefits from this?
How do you think the blockchain startups got a couple months? I don't know if you broke up a little bit.
Well, just from the ability to lean on the small business stimulus package, right now you get an extra couple months of salary for these startups. They're moving into they're getting ready to do a fundraise, and now you add a couple extra months of runway to them as they're moving into that fundraising process. I mean, that's a material difference and significant in a lot of cases, especially for something that's incredibly development focused.
Yeah, I did. I just weigh in with some, street level experience on this. I did some consulting and advisory for some local community banks on, from the early stages, translating what kind of risk, what kind of underwriting, what kind of responsibilities would the bank have, even though it's a guarantee. That's what the government says today. So I was doing a lot of work, and as it evolved, I don't know myself personally that many blockchain startups would have qualified for much of the PPP or the small business, because originally it was started out that you could categorize your key vendors, like your key 1099s, as almost like employees and part of your monthly burn. And then as that process evolved, it only turned out that your W-2s would count towards the calculation of what you could borrow. And, me personally, I guess there's some, real unicorns out there with real W-2 staff, but more of the startup guys that are getting some angel money and some friends and family money, they don't have a boatload of people on W-2 with the W-4 filing, with the NY-4 filing here in New York, and benefits. So I think the PPP, maybe the SBA emergency loan where you can get 10 grand or maximum 50 grand. But I don't, I would caution startups who, even if they do have enough W-2, if they're going out to raise money, they're kind of singing two different songs. And you have to make a lot of attestations when you're applying for that government money. So if in one instance you're telling the government, I want to get this PPP money because I've been directly or indirectly affected by the COVID and I don't know if I can stay afloat. And then in the other, you're raising money with this beautiful pro forma that says you're going to do all these great things. You're kind of making two representations at the same time. They both have the red letters in the back. You may lose all your money. But to me, the government is nice now, but they're not always nice later. And, I think some companies would probably be better off not trying to get money from the government. If they have a real product and a real forward model, they should just go to the equity markets and the investment markets, in my opinion.
The PPP from the CARES Act, it's interesting. I don't know if you saw the study or the analysis that Evercore did on a state-by-state basis, but the first appropriation from Congress, from the president, there was a real variance in which states they calculated, basically were beneficiaries of the largesse in terms of the numbers of businesses under 500 employees that would qualify, or the percentage of their businesses. And at the top of the food chain was, if memory serves me correctly, may have been Nebraska. It was one of the Midwestern states, and they got 75% of what Evercore calculated they should be entitled to based on businesses under 500. New York and California were at the bottom of the pile at 23% and 25% respectively. And I would venture a little bit of a leap that there's a disproportionate representation of blockchain businesses in New York and California. So we've got to get our fair share. I talked to a former U.S. senator who said to me that he thought that the way this was handled, it will be the biggest political scandal since the Teapot Dome. There have been some class action suits that have been filed against some of the banks because there was some indication that banks took some of their bigger clients and moved them to the head of the chain, and it wasn't done on a first come, first served basis. So now we have a second allocation. We're just starting to see some people receive funds from the second allocation, but the reports are that it's still not going to be enough to satisfy the demand for small business loans at this point in time. So, but I think it's look, it's a difficult environment, and echoing John's point, I think that many early stage companies do a lot on an independent contractor basis, and that the CARES Act doesn't do a good job of picking that piece of it up. It just picks up W-2s for the most part.
Great. Thanks for that. I'd love to move into a little bit more on the Jobs Act side. Obviously, David, you're heavily involved in that, and anyone working in that space, we applaud you. Republic, of course, really at the top of the food chain on the Reg CF and Reg A Plus side. How do you see this Reg CF and Reg A Plus moving forward post COVID? Are you seeing this as going to be potentially a cornerstone of fundraising potentially, especially maybe even on the blockchain side? As you mentioned previously, just getting meetings can be tough, right? Especially if you're looking for VC or some type of private equity capital. So people may be falling back into the Reg CF and or Reg A Plus side to approach those retail investors.
Right. Well, I think Donna made a good point, and I'll put a little bit of a wrinkle on it when she said under Regulation A Plus, it might be nice for the government to carve out the need for a transfer agent for blockchain companies. The thesis behind, and look, I bet when Regulation A Plus was originally being brought through the House, it was HR 1070. It was ultimately wrapped into the Jobs Act. What later became the Jobs Act. And it was sponsored by Representative David Schweikert of Arizona. And we worked on, putting a lot of the reporting requirements in there that were under Title II. But the thesis of doing a, sub $50 million raise is that you could take tons of $50 million raises and aggregate them, and that all of them, take 1,000 of them, all of them aggregated would still be less than the value of one, really large capitalization company like Apple blowing up. And that what you really want to do is you want to sort of take the constipation out of getting businesses started to drive, innovation, because that's ultimately how you sort of shore up your future. And so taking some risk with smaller amounts of money is actually very healthy for the long-term outlook of the country and the country's economy, and ultimately the ability to sort of sustain technological leadership and fund national security. And so that there is a strong case, and we made this in Congress, in Congress, that too much, if you will, regulation, constipation, cost, inhibition heaped on smaller companies ultimately is harmful to the country, to upward mobility, and to the long-term national security interest of every one of us. And so that we really need to kind of think of the market as two markets and safeguard large capitalization companies that and their investors that can do an awful lot of damage if one of them blows up, and they can also withstand a lot more reporting requirements and sort of take the gloves off and make it a little bit easier for people to get businesses started once again. U.S. Census Bureau has data that shows that the number of startups is on a population basis has really plummeted since in the 2000s, and in the last decade or so. We think a lot of that is because they dropped the bottom out of the small IPO market. And I'll tell you that if we really want to get the thing going, what we need is a different market structure that allows brokers to get back on the phone, market makers to make money, people to get long and loud, because a typical micro-cap security or token, for that matter, doesn't matter which, is going to be an asymmetrical order book, token or security, big seller, no buyer. And there has to be a way for somebody to go out and tell the story of that $500,000 worth of tokens that need to come into the market and be broken up when it's only trading $10,000 worth of tokens a day. And so if you can't get people behind it to market it and to place it to customers, because there's no commissions in it, there's no trading spread in it, there's no way to support it, that work doesn't get done, and they tend to trade and lend themselves very well to short sellers. So for instance, in public equity markets right now, all the pre-revenue companies, it's open season for short selling. People, there's nobody out there to tell a story and say that the story hasn't changed. So what happens is short sellers knock the stock down. Everybody says somebody knows something that I don't know. The buyers back away, the stock goes down, it becomes a self-fulfilling prophecy. And that's where, for instance, all the innovation around life sciences and future cures to cancer, medical devices sort of lives. And so as a public policy matter, it's a really dumb market structure to have. And unfortunately, that's the market structure that we live with both in equity and token markets today. You got to get people back into the middle of the equation to support smaller capitalization tokens, smaller capitalization companies. And if you can't do that and bring people back in to tell stories, to do research, and all those things, and this stuff is only going to be a shadow of what it could be. It's one of the reasons why if you look at Regulation A+ offerings right now, that I think about 80% of those offerings are restricted contractually from trading. The vast majority of them do not trade today, and they're restricted from trading. And it's probably because people have figured out that if you put a $50 million offering into the marketplace and allow it to trade, that it's probably not going to trade very well, because there's not an economic model out there to be able to provide adequate aftermarket support.
Yeah, and there are a couple, from one of the classes that I teach on smart securities, we were looking at making comparison and disclosure, and we looked at the WeWork offering that was, of course, canceled, and we looked at Telegram. And just because you had a bunch of allegedly smart investors in the WeWork doesn't mean that you didn't look at the fundamentals of the company, and most importantly, in every company, what's the governance? How's it organized? So as we invest in companies and they start to grow, and we need to put a board structure in place, we always try and make sure that as they're getting to that stage, they understand clearly how important governance is, because it is one of the lifebloods of the company. Cash and also governance. You need to rely on the expertise of your board, and the board needs to be active. In WeWork, you had a board that wasn't active, and that was a problem. And we see that often in a number of companies where they don't take that role as seriously as, for example, I do. And it's the same thing in tokens. You need to make sure that the governance structure of the network is robust and it's clear and it's fair, and that it can't be corralled.
Don, isn't it mind-boggling though that Wall Street tries to take WeWork $30 billion in valuation, $9 in the price. That gulf in valuation is so far. Then Jay Clayton, who's the SEC chair, comes out and says, we're going to make, shortly thereafter, we're going to make testing the waters available to all public companies. And it said to me that Wall Street didn't have a clue what the valuation would be on the buy side. They just, they missed it by the broadside of a barn. And I think it's because nobody's talking to anybody anymore, right? I mean, if you think about it, in the old days, when we had an equity research product that was pre-Reg FD, right? Now everybody cures any information asymmetry by putting out an 8K. The analysts don't have an edge. So there's no purpose for the buy side to talk to the sell side research analysts any longer. And in fact, when we've done some studies, the sell side, the buy side doesn't know the names of any of these research analysts any longer. So there's this incredible gulf in terms of communication going on, and trying to get the valuation right is when you're not having those conversations is very, very difficult. And I don't want to put words into SEC Chair Jay Clayton's mouth, but I suspect that one of the reasons why he wanted to make testing the waters available to all companies is because in the wake of WeWorks, it was pretty clear that they weren't having these valuation conversations that would have avoided a big sort of national embarrassment, for want of a better description.
Hey, David, it's John. When I look at this, I feel like I've tried to be at the forefront of innovation and adoption on this stuff with a lot of the work I've done with Overstock and T0. We had some great advances, but when I shift into my traditional short seller mind, I feel like when I look at all the coins out there, I'll be generous and say if you take the top 10, I like to get your thought, but if you take the top 10 most active, most liquid, liquidity seems to me to be the biggest problem with, no market making, no real market making, no rebate system, no commission system. So there's no real incentive for anybody to take risk on a daily basis. But if you took from number 10 to number 50 of all the smaller coins out there, and put them in a basket like an ETF, me personally, I would be short that basket 10 out of 10 days rather than long that basket.
I think if you'd been short almost from the get-go, you would have made a pile of money, right? I mean,
I'm talking about from now. I feel like still, other than the best in breed, anything else, if I had to have a binary, I would be short the smaller ones because all the factors are against them at this point, in my view.
well, I mean, you've got a market, right, that works when there's, as Alan Greenspan said during the dot-com bubble, when there's irrational exuberance and people are just piling into things, but they don't necessarily know what they're buying, and they don't understand them. And then when we get back into the winter, when the bubble bursts and things come back to normal and things have to trade on fundamentals, but there's nobody that's able to get on the phone and tell you, Mr. Tobacco, Mr. Investor, the story and why you should want to own it. We have every single one of these retail stockbrokers that were at Merrill Lynch and Goldman Sachs and Morgan Stanley, the old Dean Witter, I mean, they've all become asset gatherers. They don't get on the phone and tell people stories anymore. It's no longer their business model. And the real stock buying is done in the self-directed arena. And, go through TD Waterhouse and Charles Schwab and Fidelity Brokerage. And, but there's nobody saying, okay, here's this little undiscovered stock that's we're token, that's way undervalued. Let me get on the phone and call you. So we've created a market structure that for everybody but the ones that are innately visible, the network effect tokens, the network effect stocks, the Bitcoins of the world, the ethers, everything else suffers from under exposure, under support, under research, under salesmanship. They just are withering on the vine. And so what we've done is we've unwittingly created a market that has now taken the chore of aftermarket support that the market provided, and it's put it on the backs of the companies themselves, of the sponsors. And the sponsors are not big enough because when there's a news item out, they don't have a big enough megaphone. They don't have a like we did when Donna and I worked at Prudential Securities together many years ago, 8,000 retail brokers, and some subset of them, when an analyst would come out and say, load up the truck, this thing's undervalued. We had a story on the West Coast. I remember I sent a banker. There was a rumor going around that the FBI was in the office of one of our companies impounding boxes in Los Angeles. So we sent a young analyst from the investment banking office in LA over to visit the office of the company, and there was nobody there. It was business as usual. That no FBI had been there. He calls up the analyst. The analyst gets on the open mic system and says, the stock has gone from $14 all the way down to $6. The story's intact. It was just an ugly rumor that somebody spread. We went out and verified that the FBI had not been into the office. Back up the truck. And then you had all these retail brokers that would get out there and smile and dial. And the next thing you know, the stock had gone from 14 down to 6 and was back up at $12 a share and gained most of it back. That does not exist in markets any longer. I mean, that's what's been obliterated by these electronic market structures and penny tick sizes. And until you get some kind of support and real research and people talking to each other again back into micro cap tokens, micro cap securities, things that are not innately known and enjoying what academics call the network effect. Everybody, the best thing to do with Microsoft and Intel is to get out of the way and let the order book interact, because it's so large. There's 10,000 people looking at it at any point in time. But when you get into XYZ little biotech life sciences company that nobody's ever heard of, if they do something great and they make it through their phase 2 clinicals, there should be an analyst, getting out on the open mic system and brokers telling the story to a bunch of people, and the stock price should go up. That doesn't happen any longer because we basically gutted all of that research and salesmanship, the economic model that was required to get that broadcast to the market. So I think, John, you're going to make a lot of money shorting a lot of these things, because I think part of what's in your favor is the market structure until we get that fixed.
Yeah, underscoring what David said, in just one single example, there was a big to-do the first week when people were starting to cancel businesses, cancel school, et cetera, that the New York Stock Exchange was going to go from completely leave the floor. So there was going to be no trading on the New York Stock Exchange floor, of which there had not been most of the trading for quite some time now. But now nobody even blinks about the fact that 100% of the trading is not being done on the New York Stock Exchange floor. And so how do we return to any percent on the floor being more than just a backdrop for CNBC or one of the financial broadcast groups?
I'll just I want to just jump in on that one and say, a lot of what I've done in most of my career is, like I mentioned, on the short side. So I know a lot of the arbitrage houses. I know a lot of the brokers on the floor. And for the most part, the herd was culled at the New York Stock Exchange of, people that were just, rent seeking. Basically, all the people that are down there are actually providing service. And I think right now, David said earlier, it's hard to get a meeting. It's hard to, everybody's all cool and connected on Zoom, but you're not closing a deal on a Zoom for the first time with somebody breaking up and somebody having feedback. So there's definitely hindrances in even the closing cycle right now. But M&A and, certainly a whole bunch of other arbitrages, common components versus ETFs, long, short. There are people in the world, large institutions, that pay regular traditional pricing to get someone on the phone on the floor and get a look and get a handle on what kind of sizes, imbalances on the close, who's looking, buying, what, if there are any pegs. So if you ask me, for the whole engine to get going again, it may be another round of culling the herd on who actually should be on the floor. But the people that down there, in my view, are still living and making a living. They're the experts and the sharpshooters that institutions need to get things done. And I'm hoping that they get them back in there. And by the way, for as much as we all may be really excited about stepping into the new frontier and moving things forward, for the most part, I feel good knowing that there is some human redundancy, which is almost backwards these days, because the guys and the men and women that work on the New York Stock Exchange have been through everything. And if systems go down, computers go down, people go down, the NYSE, they always figure out a way to keep an orderly market. So I feel uncomfortable not having some humans down there, because I think the ultimate circuit breaker was always that. So I'm hoping they get the NYSE back in action for a lot of reasons.
Great. Yeah. That's super helpful. On the discussion of the top 10 market cap tokens versus those below it, or maybe even the top 20, there's a continuing liquidity issue that we keep running into. If you look at the real market cap of the top 10 and even just the top 5, that really represents 90+%, if not more, of the actual market cap of the entire space. So as you start to see people trying to inject money in those below it, and it just gets kind of eaten up into sell walls and distributed amongst the people trying to just move those prices. I don't really see a clear path. And David, to build on what you're saying, I don't see a clear path for those in the sub 20 range to be able to overtake and move into that top 10. I'd love to know some ideas or concepts, David, that you'd be interested in, and Donna as well, of how we can help those either newly released tokens that have strong fundamental backing to be able to make that movement and give them the exposure necessary in order to take a foothold in that, let's say, top 20 space.
I think you need to have a fundamentally different market structure for dramatically smaller companies. There was a bill that we got through the House of Representatives 406-4 that was to put forward a new kind of exchange structure called a venture exchange, which would have essentially liberated people that design exchanges from things like the national market system, from penny tick sizes, decimalization, and Reg ATS, alternative trading systems, just to try and allow somebody to go back to what we had in the 80s, which was a telephone quoted market with tick sizes, minimum increments that you trade a security or a token in of something more than a penny, so that you could start to get some economics back into market making. What you're describing on 10 tokens working well is not dissimilar from what you see in the stock markets, which is a group of large cap stocks working well, which is these are innately, intrinsically liquid and visible tokens, securities. It's the same thing that we saw in the private market trading that Barry Silbert of Digital Currency Fund, when he was over at Second Markets, was doing, where 80% of the trading in the private markets at the time before Facebook went public was in names like Facebook and LinkedIn. And so, you know, we have a market structure right now that really only allows people to transact in intrinsically liquid, large capitalization, network effect, tokens and securities, the big visible names, and everybody else that needs the support gets crushed by this market structure. You know, and so, you know, if I had to give advice, and I'm an investment banker, to a client, I would say in the token area, you don't want these things to trade unless you have a proxy for value. So for instance, you know, tokens that are in real estate with high yields associated with them and dividends, they may trade better. They may have a shot at doing because they're more bond-like. But if you just do something that it takes on more equity kinds of characteristics, meaning that it needs a story and you need to understand the forward, it's a sub-$5 market trade, terribly won't be supported in the market. And when people are not, when there's no enthusiasm behind it, no irrational exuberance, people just throwing money at it, then all of a sudden, you know, somebody wants to get out of it in size. You need somebody to tell the story and smile and dial and replace those shares or those tokens. There's not anybody to do that, and that's why that market structure doesn't work. And that's why what you observe, John, in the bottom tier of this is, and you're exactly right, they're all shorts, but they're shorts largely because of a market structure effect as much as a fundamental effect, meaning that there's nobody there that can be made to care. They don't, and they're not going to trade organically because they're just not big enough, given the hyper efficiency of today's market structures.
Yeah, the other thing I would say, and it's a different market structure, I think, David, that we're talking about in the security token market, that doesn't have a structure yet, and we're still waiting for this whole. It itself is a startup composed of many startups, all of which need to have some direction, not only from the regulators, but also from the support of people that want to grow that market. I mean, markets don't only grow organically. They need people that are committed to making markets, to supporting the companies, to supporting the exchanges. And, you know, as you well know, it's not so easy to do that. And until we have a more focused approach on how do we build this market together in, let's say, security tokens, there's not one company that can just do it by themselves.
Well, you know, the book Crossing the Chasm, and you know, if you look at investor penetration of the token market right now, broadly defined crypto, it's probably 10% or less of investors out there. And the question is, how do you get broad adoption into all investors? And until, you know, you can get tokens deposited into DTCC so that those tokens can be reflected into your account at an investor's account at Morgan Stanley, until you can get firms like State Street and Fidelity doing custody so that the big institutional money will move into the space, because they're fiduciaries, they can't afford to take a risk. You need that penetration. You need it to get opened up, and we're still in the early throes of sort of broad adoption by the vast majority of big money investors, I think.
Yeah. I mean, you rightly used the word, I think maybe it's the first time we've used it, which is custody. That is a key component, because if you have a fiduciary responsibility, that's the one thing that you can't really take a risk at. You can take a risk at price, you can take a risk at what instrument you decide to buy, but custody is something that's pretty much ordained within the legal framework, and you can't not address that element first before you then go over to other aspects of the structure and what you want to buy and how much you want to buy, et cetera.
And because you can't afford to take a risk, you know, if you're a fiduciary, you want to go to a trusted partner. You want to go to State Street for custody or Fidelity, or you want to transact through Morgan Stanley, and because you want that throat to choke to be somebody that you've counted on and you've trusted for years and years. And so for them, you want to see them, pick up the baton and start to integrate this into their traditional systems before you're going to make commitments into tokens. And so far we haven't seen that happen.
The other thing I would ask maybe either one of you, and I know that Andrew had said that we were going to try and cover a little bit of the oil market or something like that, which I'll pose it a different way, which is what recently happened in the spot market in oil in relation to the ETF, which the underlying is a commodity trading in the spot. Do we think that makes it easier or harder to get a Bitcoin ETF?
Yeah, I would argue that it's going to hopefully make it easier. I think I'm hopeful that path is going to continue to open. I think as everyone is looking for alternative investments and additional stores of capital or stores of wealth, and we start to see more and more capital fleeing into digital assets, and whether that's in the U.S. or elsewhere, I think the pressure on that is going to continue to mount. I think we already know pretty conclusively that SEC is heavily considering this, and they have a number of items that they're trying to check off their list to cover the basis to protect consumers. But now it's much less a matter of if, but when. I do think, and this actually circles back to what we were saying before, that COVID's going to slow it down. I think it makes what we're seeing in oil makes it more probable, but what we're seeing with COVID is going to actually extend the length it's going to take to make that happen. Even from any regulatory standpoint, now with most of the people that are focused on that having to either work from home for the past couple months or in some type of remote capacity, the output of that regulatory framework is just going to be delayed even further. Oh, John, you're on mute.
I think there's definitely a lesson to be learned in analyzing the oil ETF and what the influence on the spot market, to be prepared for what the combination, the CFTC and the SEC will come back with questions about.
Yeah, I know sometimes when I put my full crypto hat on, and I'm in the zone and telling, yeah, there should be an ETF. But then, other times when I put my traditional hat on and I start thinking about, well, what would be in a Bitcoin ETF, to the point of what, David and I were talking about earlier, what would be in it? Some weighted position in just Bitcoin, or when everyone keeps talking about crypto ETF, Bitcoin ETF, is just one holding, and theoretical.
It's a single stock futures, a single stock ETF. Or a single token ETF. The idea is, I believe, is just to get it into the traditional system so that the average person can have exposure, which is again a crossing the chasm exercise. But
right, that's what I'm saying. So I think sometimes everybody gets caught up in the great fight for innovation to get an ETF, but what is it? It's a single stock future. It's a single stock future. It's not to me, it's not an ETF by traditionally what they came out as. And if you want to get exposure to Bitcoin, I think at this point, anybody that has a will and a little bit of awareness can get themselves exposure. So I understand the crossing of the Rubicon to another great milestone for cryptocurrency if Bitcoin can have its own ETF. But at the same time, I don't understand what that instrument means to it, because I think if you look at the oil and stuff, it almost hurts it, because the especially as soon as there's an ETF, then someone will come out with a leveraged ETF. And then all these things, they reweight daily, but the management fee carries annually. So they don't actually trade in any correlated way to the Bitcoin. I almost feel like bastardizing the libertarian side of Bitcoin to put it in an ETF.
I think we're still battling, though, the main issue here of just overall poor custodial solutions, right? If you say there's a will, there's a way, and of course people can go create their own wallet, go purchase on a variety of different exchanges, but from an institutional perspective, or for someone who may not be crypto savvy or has a fear of being able to protect those assets, the ETF is a stepping point for them, right? Has the ability for them to get exposure without having to take the custodial risks that are accessible to everybody else. And until we have true institutional custodial partners, which we continue to struggle to get, obviously we have a lot of additional custodial options that are coming online, and there's a lot of capital being flowed in that direction, but it's still not there yet, right? So I think I look at the ETF as a stopgap while we wait for more and more institutional adoption from a custodial perspective.
Well, and to your point, Andrew, it makes it actually has a lot of utility to a lot of investors. I mean, people would love to see an ETF. I mean, they're afraid of, having a cyber wallet, dealing with the custody. It's essentially outsourcing it. But the flip side is that the SEC, I think, intuitively understands that. And they know that the underlying market for Bitcoin is, not particularly transparent. It's highly fragmented. And you got to worry about the custody of the ETF sponsor, and because you wouldn't want to lose a whole ton of Bitcoin, and so there's been this taffy pull going on. Is when does the SEC get themselves through their due diligence comfortable that the benefit to the ETF purchasers will be delivered. And I think that what happened recently with the ETFs and oil spot prices and everything, probably, is another reason to pause for and have some concern about what could go wrong in some of these with some of these ETFs. So I think it's going to be longer. I mean, John made a good point. There's nothing getting done right now. The basic fund, that's really innovative. All that's going to slow down for a period of time. And I think some of the lessons that anytime you have shocks to markets like we've had right now, you start to see some things that were not stress tested that come to your attention, come to the SEC's attention. There tend to be hearings, and we go through a period of time where we try and put fixes in. And I think we're going to see a little bit of that once we get back to work.
Excellent. I think we're a little over an hour here, so I'm going to jump into a couple Q&A if you guys don't mind, as I see coming into the chat. One of the questions being, do you see more adoption of using security tokens for Reg D 506C recently?
I think we've seen more. But as we indicated, that's a private placement. That's accredited investors only, and so in theory, if we're just going to leave out that they might be able to swap or trade with another accredited investor, you're sitting there for a year before you're allowed to trade it to a retail person. So I think that a lot of people that are in the token market, different than investors in startups that know they have a period of time to wait until some results for the startup come, and they could get maybe their convertible note done, and they could be in a Series A. I think that the mentality of tokens and crypto has been more on turnover as opposed to longer term holding. Now, I like longer term holding, but that's not the way many people make money in markets. They need to be able to trade them.
In the United States, if you look at the options that present, we're doing more in 506C and Weild Co for tokens, and got a group, folks know Elliot Chonman on the East Coast that runs Emergence, and then on the West Coast we have people in our other firm architect partners at Weild Co, and Steve Payne and Eric Risley who work in this space. The problem is that the public markets right now in the United States are challenging because, on the one hand, INX, we've been in front of the SEC for over 2 years, okay, to register a token. publicly. The second part is that it's been very difficult to get the exchanges to want to list a token. And then what happens is if they won't list a token, you get stuck in blue sky hell in the aftermarket, which means that in order to trade it, you're now in the over-the-counter market. You don't get an exemption from state registration, and God help you, because now you've got to deal with all of these individual state regulators and trying to talk to them about allowing you to market a token in their state. And so if you can imagine the friction that you have with the SEC going through this process for the first time, now you've got to deal with a number of state regulators. And so, it's the old adage, which I get the cliche wrong, but about pioneers get arrows in their back, and that's a little bit of what happens when you're trying to go through this whole regulatory morass first, and there isn't an obvious exchange listing exemption or exchange willing to make a listing of a token in the public market, and you also can't get the tokens, at least not so far, into DTCC so that it'll show up on somebody's account at E-Trade or Morgan Stanley or so on and so forth. So you're stuck for the most part doing things in the private market or doing a public registration on a Regulation A+, and so that you can distribute it publicly, but you may not want to trade it because, again, you'll be stuck in the over-the-counter market. In the aftermarket, you won't be able to get a NASDAQ or a New York Stock Exchange listing, at least at this point.
And as we saw on Blockstream, which was, again, a pioneer, like you were a pioneer, they were a pioneer in the Reg A plus space for crypto, and they have a 2-year waiting period for trading in the U.S., whereas they can trade overseas.
Yeah, one of the things that I had kind of zeroed in on about 2 years ago when I left T0 was that I knew from some of the things we had done with Overstock that people that had that could amend their S3 or issuers that were already public would have a lot greater chance at doing some kind of digital instrument that you could actually get a QSIP for, or not yet, but soon, hopefully, trade in the T0 ATS. And I was amazed throughout the whole process of, we were able to get the first ATS approved for trading of digital securities. That was Pro Securities, a division of T0. But it was amazing how every single last step of what was allowed in traditional securities, we had to continue to push the regulators to let us do the same thing that happened in the ATS when it was just for traditional securities. And, I think across the board, what I see is that these 506Cs, these Reg A pluses, all the stuff that was supposed to be really sexy and new after the Jobs Act and everything else, David hit it right on the head. If there's no liquidity, then the sexiness that existed a couple of years ago, where you didn't need thousands of brokers on the phone telling people a story, is gone. So if there's no liquidity, then you're basically back to a paper private placement. And if you need to get out of it, it's a discount market because you got to basically sell it at a discount, at a loss, to find liquidity. And I don't, in the uncertainty these days, I don't know, other than top-notch, best in breed, I don't know who wants to take the risk of having zero liquidity. You may be better off with a regular private placement with a good group of angels in some instances.
No, absolutely. No, really good insight there. So let me grab one more question out of here while we still have time. From Emma, what regulation for crypto or the token space do you expect to change as a result of COVID-19?
I think we said that that any change would probably take longer. because there's so many other priorities right now at the SEC. So we're all looking for some clarity by both the SEC, the CFTC, FinCEN, et cetera, all together that apply to the space in not only crypto, but in security tokens, as we mentioned, the transfer agents, et cetera. So I don't think that the direction has fundamentally changed. I think the time horizon may be longer to sort through what changes need to be made.
Yeah, I don't expect that COVID is going to cause any. COVID itself will change. Will change any regulations in the crypto or token space.
Great. And then the last question, I think I don't want to wrap up with here, and certainly probably one of the hotter topics for those who've been in the crypto space a long time, and those in particular who are around for the previous halvening, is we're approaching the halvening here around May 12th-ish, approximately. How are you guys looking at that? What are some of your expectations comparing this halvening to some previous ones? And really, what do you see the long-term benefit to the space following that process?
From my perspective, I'm on the board of a company called InvestView, who has a pretty large community mining operation. We've kind of been angling it from every perspective over the last 6 months or so. And I think it goes back a little to some of my macros on the top cryptocurrencies. There's this ecosystem of growth of the whole Bitcoin economy, and the way I look at it is, we're positioned with good power costs and good technology to withstand the halvening. And I think it's the survival of the fittest again, best in breed. The little guys who have been on the run for the last couple of years mining, they're not going to be able to afford to do it if they're not doing it efficiently and at scale. So there'll be more capture out there for people that could run at capacity utilization and withstand, and enhance their performance. So I think it's a natural part of the evolution of the Bitcoin ecosystem. People will go away. I think, I think it has a positive upside effect on Bitcoin. While there may be some manipulative maneuvers that we see from time to time over the next couple of months to coincide with it, that's a whole nother story. But I think, at the end of the day, it strengthens the system out there. Because it takes small nodes, who may have been able to profit off for a little while, but it takes small nodes out of the equation. And the people, the operators that are out there are doing it at, institutional, scalable grade.
Anyone else want to hop in on that topic?
I mean, I think the thesis is that the price should increase, right? So, you end up with, you less Bitcoins put on the market, and the same buy pressure, and the price is going to increase. I think that's the thought process behind it. But like a lot of things, how much of it's going to be baked in before May 12th. And people are, if it was a professional market, I'd say, sell on the, buy on the news and sell on the event, right?
Yep. Nope. Absolutely. All right. I think that pretty much wraps up this session. I'd encourage you guys to maybe just take a couple minutes if there's anything that you want to touch on real quick before we wrap up. But otherwise, I think everyone really appreciated everyone's time today. So Donna, if there's anything else you want to touch on, then we'll go David and we'll go John, and otherwise we can wrap up there.
No, I'm good. I just think this is a incredibly difficult, but at the same time interesting historical period that we're going through. And we will see how it rolls out, not only for regular markets, but also crypto blockchain. I do think blockchain, as opposed to trading markets, blockchain as an underlying technology has shown that it's going to be more and more important. And so I think that there will be many blockchain projects in development or applications of existing projects to help in many, many different kinds of things that we've seen, whether they are supply chain all the way on down.
Look, I mean, we're being a little, negative, but it's an amazing technology. I mean, if you look at the whole stack from, here's the token to here's the smart contract and here's the block. There's so much that you can do with that to automate things and to innovate in terms of token and security structured private markets. We need a benevolent regulator. We need a regulator that's going to push it through. We need some market structure is dictated by regulation frequently, and what we do with token trading is going to be no different. But the core technologies from starting with the hash down to the smart contract down to the block, in combination or individually, allow you to do a wide range of things that haven't been done before. And so I think we're in for a very interesting next decade. But I think somebody smarter than I once said is that technology is the impact of technology is frequently overestimated in the short term and underestimated in the long term. And I think that blockchain, smart contracts, and tokens as a bundle, I think, are going to be woefully underestimated over the long run. You have we started out with physical delivery of stock certificates. We went to DTCC, and there was a transition where we had both stock certificates and DTCC, and now we're going into the token era, and it'll be slow and gradual, but I think it will be absolutely amazing, the kinds of tokenizations that you see coming out of this technology.
Excellent. And Donna, if you have to bounce, by all means, go. Thank you so much for your time today.
Well, it was great to join. Thanks.
Okay, thank you, Donna. Yeah,
Thanks,
hey, thank you guys. All I would say is, even at my most zealous moments in pursuit of innovation with blockchain, I always in my mind kind of had this outlying thing that when I was going to conferences and talking to people, and I felt like the blockchain concept of a decentralized database that can have, provenance and security, that was always a beautiful thing to me as a libertarian, a free market capitalist. But I did find myself many times at conferences with big people from big consulting firms, and I would think in my head, like, the smart contract plus the blockchain, this is a solution looking for a problem in a lot of instances. We can apply it to this, we can apply it to that, we can apply it to that. And a lot of times when I would look at it, say, that's not a security token, it's a private placement. That's it. You know what I mean? There was no new innovation there. So I have always kept my reality cap on to think that as a technologist, blockchain is something that will change the world ultimately. But I think, people that want to harness it and take the beauty of how the community has grown the adoption of Bitcoin as a cryptocurrency, try to find something in there where what you're doing is actually solving a problem, not this great idea looking for a problem to solve. And, to me, those innovators, those thought leaders, those seekers of truth, those will be the people that, are the beneficiaries. But as David said, it's going to be a long road to hoe.
Yep, couldn't agree more. Guys, thanks so much for your time today, and listeners, thanks for tuning in. Blockchain Center, of course, thanks for putting this together. Everyone, stay tuned for more content from the Blockchain Center. And if you haven't dialed into your local chapter, whether that's in New York or Miami, be sure to look them up. But thanks, guys. Everyone have a
Thanks,
wonderful.
guys. Good talking.
Andrew, thank you. John, nice to see you.
Say-
Bye.